Let's talk about BCE stock today. So right now it's yielding around 9.1%, which is an extremely high yield. And normally, you're getting a yield of maybe 4 or 5% for fairly high yielding stocks. This is very high territory, but even for BCE. Now it's a pretty big company in Canada, a big telecom provider. It's fairly stable and has a good business, but this year it's down 15% and has just not been doing well. And it's despite its yield, it's still not attracting a lot of investors. So the concern may be that it's not really sustainable. And there are a couple of charts we can look at, or a couple of different things to analyze whether it's really safe or not. So one of the things I want to show you is its payout ratio. Right now, it's really high, 190%. This is a lot higher than it's been at in the past. You can see it's not uncommon for its payout ratio to be at over 100%, especially after 2020. Before that, it was normally below 100. So it's definitely been elevated for a while now. And right now at 190%, that's extremely high. And if you look at its historical dividend yield, this other chart here, right now it's not updated, but 8.9%, that's also well above where it's normally been. Normally you're looking around 6% in 2020. Back here you're looking at about 4 to 5% back when the stock was doing fairly well and it wasn't sinking like this. Now obviously that's the trade-off. When a stock goes down, the yield goes up. That's an inverse relationship. So that's why it can be appealing sometimes to buy a stock that's not doing well, because the yield is a lot higher. Now, as long as that dividend is safe. Now, another thing to consider is that BCE's also been increasing its dividend consistently over the past 10 years. So this has been a really good dividend growth stock. But right now, the danger is that yield sustainable? Just because, obviously that payout ratio is extremely high. So that means that the company's paying out a lot more in dividends than it's generating in earnings. And if you look at its most recent quarterly report, operating revenue was about flat, but net earnings dropped significantly by 42%, so almost in half. Now the company says they did a lot of restructuring, a lot of layoffs. I mean, you've got severance, you've got a lot of one-time expenses there that are weighing down its numbers. And the problem is, is it going to actually recover? Is it going to do a lot better? Now, one thing I like to look at is the free cash flow, because this tells you how much a company is generating in free cash versus how much it's paying out in dividends. So if we look at over the trailing 12 months, BC's free cash flow is just over $3 billion, let's say around $3.1 billion. But if we look at its dividends paid about $3.7 billion. So it's considerably more in cash that it's paid out over the past 12 months versus what it's brought in. So that's also not a good sign, especially when you factor in with the high payout ratio as well. Now, if we look at historically on an annual basis, what does that look like? Has there always been a gap? You can see, in the past, free cash flow has been less than the dividends. And this year was 2021. The gap was significant. It was even worse, right? And free cash flow can fluctuate, but if we go back here to 2020, free cash flow was more than the cash dividends paid. So it's a bit of a mixed bag with BCE. It's hard to really gauge, whether it's going to make an adjustment to its dividend or not. Because that delta between free cash flow and cash dividends paid was actually worse in previous years, and it's actually improved. That gap has shrunk a little bit in the sense that there's not a gap as 1.1 versus 3.2. And the thing is with free cash flow, it can change from one period to another depending on the collection of receivables and how quickly a company is paying its bills. So it doesn't guarantee that a dividend cut is going to happen. Obviously, these things don't look terribly great right now when you look at its payout ratio, you look at its free cash flow. It's not looking terribly good. But the reason I would still stay optimistic about the stock is because, obviously they've spent a lot of money in terms of restructuring, in getting rid of positions, reducing headcount. So all those things should improve profitability and free cash flow in the future. So even though right now the stock does look like it might be in trouble just because its yield is so high, its profits are down significantly. Those could prove to be temporary factors, because if if reducing the workforce leads to better profits, then that will improve, and that will make that payout ratio look a lot better. So right now it's not a popular stock just because of, it's been generating some pretty underwhelming numbers, but it's worth keeping an eye on, because if in the next quarter or two it starts to reap the benefit of those reductions in staff, then the numbers could start looking a lot better. And if rate cuts happen again and interest rates come down, then BCE might be a bit more of an attractive buy for its high yielding dividends. So there's multiple factors that could make this a much better buy in the months ahead. So it's worth keeping an eye on it. And if you're willing to take on a little bit of risk, I think it still could be a good dividend stock to own, just because even if it does reduce its dividend, odds are you could still be generating a pretty good yield from the stock, at least 4 or 5% potentially. Let's say if it cut it close to half, so you could still be getting a fairly good yield from the stock. And at the same time, this is a fairly stable and safe business to be investing in, just because there's limited competition in the Canadian telecom market. BCE is a really big name. It's still doing well, even though it didn't generate much revenue growth, or any revenue growth actually this past quarter. It's a pretty stable business to invest in, obviously, as it's adjusting its workforce and being more profitable. I think that its fundamentals will improve as well. So even though it's not a popular stock to buy right now and it hasn't been doing well, I think in the long run this could still be a good buy, especially for its dividend and its stability in the long run.